You know what you're watching. DS Learning Finance. Whoa.
Oh, snap. You don't want to see that. If you're watching this video, guys, chances are that you're trying to look for the ultimate stock to invest in right now, this very second, right? Only problem is there's no ultimate stock to invest in. That term doesn't exist. I know, anticlimax, right? It's peak. But what this video is here for is to tell you the characteristics and the traits of the ultimate stock if it were to exist. Now, obviously, as mentioned, it's impossible to get to that stage to find that stock that is the ultimate, but there are some that are closer to it than others. Now, getting into it, we're going to talk about the fundamentals first. I promise I'm going to get onto the stuff that I can pretty much say you won't have heard of. Yep, there's some new. I'm going to drop some gems today, but I'm going to have to go through the basic stuff first, and that is assets versus liabilities. I apologize, my handwriting is so bad. Other terms that they use for liabilities in the stock market is debt, and also watch out for the term borrowings, because these things mean the exact same thing. But simply, what you want to know is how the company's assets fares against its liabilities, debts, borrowings. And the way that the stock market uses this is in two terms. So they use current assets and non-current assets. We all know what those are. Current are short-term assets and short-term debts. And non-current is long-term assets and long-term debts. So you want to simply know, has the company got enough money to cover all of its debts? And obviously you don't invest in a stock that has more of this and less of this, because it means that they can become bankrupt any moment. And I know you guys don't want to invest in stocks that are bankrupt, right? Yeah, cool. Got that sorted. The next point I'm going to talk about is, you probably guessed it, revenue, profits, and there's also a third term that most people forget about, I would say, cost. I write in brackets if lucky. So what you want the revenue to be doing is you want it to be going up year to year. You want that revenue to be increasing. Profits you want to be increasing as well, because this is stock you own. You want to make sure that that company is making profit on top of profit. It's progression in the future. And then you also have costs which you want to decrease. Yep. Now these two, it's quite easy to get stock. Well, not easy, granted it's not easy, but it's relatively easy to find stocks that have increase in profits and increase in revenues. But what's difficult is to find a stock that does this, has decreasing costs, because of one term, inflation. So even if a company was to remain stationary, they've automatically got to pay more than they did last year and the years before because of inflation, because their pound is worth less, because their dollar, their euros, whatever is worth less. So they've automatically got to contribute more of it to buy the exact same thing. And that would only put the company at a standstill. It wouldn't even progress the company. So, and also when you think about it from the other aspects, costs are a bad thing, and they include liabilities, debts, borrowings, all sorts. But also you can have a good debt, for example. So an example of a good debt is, yes, a company's taking out the money from a bank. Maybe they borrowed it from a creditor, but if they're using that money and sending it back into the company to invest for research, maybe that can be the beginning, the springing platform to launch a new product that would then bring it back into there and back into there. So ultimately, this is very hard to go down because of A, it's just hard to meet inflation rates, and B, without a company increasing its costs, it's unlikely to increase its profits unless it's very, very good. Yeah? Cool. So I'm just going to rub this part out because that's just messy. I told you my handwriting was quite bad, didn't I? Yeah. These 2 points are given. The points I'm going to discuss afterwards are based on the company that you're looking at that has these 2 points. They've got revenues and profits increasing. That's cool. Ideally costs decreasing, but we know that's very hard to achieve with a progressing company. And also they've got more assets, tons of assets that cover all their liabilities, debts and borrowings. Cool, we've got that straight. Now we're going to talk about the points that aren't discussed as much. And as a long-term to medium-term investor, I look for a company that has this thing, long-term success. And that's very generic, I know. Trust me, I know. But there is a formula I like to use that can break it down and make things a bit simpler. So, long-term success, in my opinion, equals long-term aspirations times, okay, you're not gonna guess it, okay, cool. Long-term aspirations times realistic actions taken. So in order for a company to have long-term success, it's got to have a vision that projects in the future for multiple years, and that vision means that the company will be progressing in the future. Cool. But also, you can't just be a dreamer. You've got to be taking the necessary steps and realistic steps towards that long-term aspiration. And in my opinion, that equals long-term success. So for me, as a long to medium term investor, I look for a company that has this. Because what that means is then I'm more likely, eventually, down the line, however many years it is down the line, when I sell my shares in that company, I'm more likely to sell it at a overvalued price rather than just for profit. And I know there'll be some of you that are like scratching your heads like, aren't they the same thing? They're actually not, guys. They're actually not. So you want to sell your stocks at overvalued price compared to a profit. I think it's probably best to explain it in terms of a graph. So say for example, this is your graph. This is time. I'm not a drawer either, as well as a writer. Guys, I'm pretty bad. But yeah, say this is share price. So SP share price in pounds per share. Yeah, cool. So let's say your stock starts from 0. It goes up, goes down, goes up, goes down, goes up, goes down. Cool. You buy the stock at 0. Well, obviously that's impossible. Let's not say that. Let's say you buy the stock is at 1. And the maximum overpriced value is here at 10. So you bought it at £1 and the maximum overvalued price that it can ever get to is 10. If you focus on this more than this, you could sell here, you could sell here, you could sell there, you could sell there, you could sell there, you could sell there, sell. You guys get the drift of what I'm trying to say. You can sell at any value which is above that £1. And yes, you'll be making a profit, which is excellent. But when you sell at the maximum overvalued price, what you're saying is you're selling at there. And what it focuses for you to do as an investor is not just think about the price. It focuses you to visualize the company, think about the business as well. And that is a better way to judge when to sell your shares compared to profits. So you always want to sell at overvalue, at the maximum overvalue price, because it gets you into the mind frame of understanding that company. Can this company be any higher than this in the future? If I can't see that, then guess what? I've made the maximum amount of profit I possibly could. My next point, which is my final point, that a lot of you guys, I reckon, haven't heard about this too much. And that is looking for a stock that is going down. Yep, I told you it was gonna confuse you, isn't it? Yep, I know. Now this, understanding this is assuming a big thing. It's assuming that the company has this, and this. So if you put this to the top, then you could very well be in a losing company, a company that will never ever make you money. But if you have this as your final assessment, after the company has this, and this first, well, these two things first, and then this coming after, you could be onto a big winner. So what you want to be looking for is a stock that is going down in share price. And the reason is because you've done the research, you know that company's not going to be bankrupt, it's got enough assets to cover itself, and it's making revenue and profit. And it's also got long-term success, so it's not just at a standstill. It's not just a one-off for that year or years that have passed. You know this is going to be recurring in the future. But this time the stock price is going down, and what that allows you to really assess is that that company is undervalued. So as an investor, you've really got to make sure you do your research on this, and this. And you would get this information from the financials, and you get this information from the business plan. And that's what allows you to make this judgment on the company. So if you feel like the stocks are down, don't think about it in terms of the long term, because guess what? You know the business is straight. Well, the business is straight, and you know that they've got enough money to cover themselves in the future, and they're making more money. It's just the fact that the public doesn't see this company as a good company, but it is a good company. So the fact that I'm buying this stock at here, the low points, means that because I know it's going to go up in the future, I've got this amount of profit, I've got this amount of profit, I've got this amount of profit, this amount of profit, this and this amount of profit to capitalize from. And you've got to remember, in the stock market, what makes you money is not, well, there's two ways to make you money. It's dividend, but when you sell your shares at the end of the day, after you've finished all your trades with that company, you're looking to sell your shares. When you sell your shares, it's the difference in money that you make that makes you money. It's not the fact that you bought the share price at this price. It's not the fact that you sell the share price at that price. It's the difference. You need the difference in terms of selling price to be greater than the difference in terms of buying price. And the maximum amount of difference you can get is by understanding this term, the overvaluation of the company, and also understanding what is the minimum point that you think this company can go down to. And selling at the overvalue point and buying at the minimum point, that will mean that you get the most profit. You've got to remember, guys, that the people investing in the stock market, it's myself, it's you, it's the person next to you. Maybe you're not investing right now, but what I'm trying to say is it's humans. And what humans are, frankly put, is emotional beings. Now, that is a good thing and that's also a bad thing. But what that allows you to determine is the way that they will behave. Because we have behavioral patterns with our emotions. So when a piece of information comes up about a company, you can be you can learn how to predict how the public will portray that company, and if that goes down, but the company's perfectly sound, why not buy prices? Why not buy shares then? Because you're going to maximize your amount, and that's basically what I like to look at in the ultimate stock if it were to exist. But there are some that are closer. You get what I mean? Oh yeah, I've got stock market investment books that I've read in the past. I've left them in the short description box below. Yeah, they give me a lot of information about the stock market, but also inspire me, which is very important. And if you guys are interested in getting inspired as well as learning more about the stock market, then definitely read those books. Yeah, now. Okay, maybe not now. Now then. Okay, if not now, then do it now. You get the drift, right? It's your favorite YouTuber, guys, Danny Solari. I talk about stock market investments, property investments, financial management too. Give me that consistent content, you know? Before you can go out there, what are we going to do for the rest of the day? Say with me. Why is there an aeroplane flying over? Like, dude, why? What is this? Like, subscribe, and share. DS Learning Finance. Whoa.
Whoa.
Bye.